The economy has held up better than expected this year. The unemployment rate is near a 50-year low. Wage growth outpacing inflation once again. GDP rose more than 5% last quarter. So why don't people feel better? Could be a few reasons. Like this, both carried balances and interest rates on credit cards are near record highs after all the Fed's hikes. Delinquencies are jumping now to nearly 3%, a level not seen since 2012, nearly double the 1.5% rate from a couple of years ago. Just how big of a red flag is that for the economy? Let's ask Ted Rossman, Bankrate.com senior industry analyst. And, I mean, so far people have said, okay, it's moving in the wrong. I would say we've heard a little bit more concern from earnings season, from some of the companies maybe on the front lines of these deteriorating trends.
Yeah, I think it depends where you are on the spectrum for consumers, but also for these card issuers. Like American Express is doing really well because they have a more affluent customer base. They're not as likely to be delinquent. They're spending a lot on travel and holiday gifts. You have some of the store card issuers, some of the more subprime issuers. They're not doing as well. And I think that's indicative of the customer environment right now. In general, credit's still flowing freely. Originations are within about 2% of the all-time high set last year. But we're starting to see some tightening, especially on the margins, people with lower incomes and lower credit scores.
So should the Fed cut rates? Would that help?
I don't think it makes that much of a difference for credit cards, just because these rates are high, period. I mean, right now, the average is a record high 20.72%. I mean, honestly, even if that fell 3 or 4 or 5 points, it would still be high. So that's where the advice is pay it off if you can. To my surprise, 0% balance transfer offers are still widely available. I think that speaks to the strong job market and the fact that delinquencies, while they're up, are still relatively low, all things considered. People are carrying debt, but they're paying it back. So that's why credit's still flowing.
Overall, on the kind of the macro level, it seems the balance sheets are nowhere near as stretched as they were before the great financial crisis.
Well, that's what's so interesting, too. The household debt-to-income ratio is very low, historically speaking. So I think that flies in the face of some of these other trends, which are highest credit card rates ever, highest credit card balances ever. I mean, you don't have to look too far to find negativity, the fact that the delinquency rate has doubled in 2 years. But the other side is that debt-to-income ratio is pretty low. It gets back to sentiment, though. None of this feels good because of inflation. Most people are doing okay, but again, it depends where you are on the spectrum.
Lower gas prices have to be delivering at least some conceptual relief and some actual relief.
Psychologically, yes. I mean, also in terms of expenditures, I think psychologically more than anything. That's one that we just see every day driving around. The fact that wage growth is outpacing inflation now, we want to see more of that. It's really a mixed bag, and it really speaks to that K-shaped economy where some people are doing quite well, others are struggling. I do worry that cracks are starting to emerge in terms of delinquencies, but also, where do we go from here? Do we kind of level off? Or if the job market gets worse, do we see more of a substantial rise in delinquencies?
What usually happens?
Traditionally, the credit card charge-off rate matches the unemployment rate. So we really look to that as a major indicator. Banks don't seem too concerned right now. I mean, it seems that they're still talking about normalization. We've actually gone a little past normal in terms of we've surpassed 2019 levels of delinquency. Now we're back to more like 2012, which was that Great Recession recovery period. It remains to be seen. I think banks are expecting that rate to level off. They're not expecting it to continue to jump, but it bears watching, and I think the job market's a big part of it.
What about the autos piece of this? We mentioned that those borrowing rates are very high, and obviously those prices went up a lot during the pandemic. How does that impact people?
Subprime auto delinquencies are worse now than during the financial crisis. So
Wow.
I think that's probably even more of a worry than credit cards right now. I think a lot of it speaks to how much car prices are up. That's been an even bigger factor than rates, I would say. Unfortunately, it doesn't seem like a lot of relief coming there. So in many cases, the option is either stick with what you've got for longer or bite the bullet and pay the higher prices. But that's getting some people into trouble from a financing standpoint.